What's up, everybody? It's Walt Key. Today, I'm going to talk briefly about the greatest wealth building tool in the history of mankind. And as we all know, that's real estate. Many people have built their wealth over years in real estate investing. Even a famous billionaire, Andrew Carnegie, once said that 90% of the millionaires of the world built their wealth through real estate investing. Now, I don't know if Andrew Carnegie pulled that number out of thin air or if he actually ran the data. 90% might not be the right metric, but for sure, many people have built wealth in real estate. And so I'm going to talk a little bit about how you can do the same thing. Now, there are many different metrics to evaluate when you're looking at a potential real estate investment. There are well over a dozen quality metrics that you can use. And I'm not going to get into all of those today. As a real estate investor, as someone who has bought properties in the past, who's sold and managed and rented properties in the past, I still own real estate to this day. I'm going to talk about my favorite three, and I think that they're the most important three as you start looking at real estate specifically for investment purposes. And so those three metrics that I'm going to talk about are net operating income, cash flow, and cash on cash return on investment. And again, there are many more metrics out there. Today, I want to keep this short and to the point, so I'm just going to cover those three. So the first one is net operating income. Now, this is essentially a basic income statement. This is going to be your income that the property produces for you minus your operating expenses. Now, operating expenses is not all of your expenses. That's only the things like utilities, management fees if you're paying them, all of the other things it takes to run that investment. That doesn't include your mortgage. It doesn't include taxes, appreciation, things like that. So net operating income is a pretty simple metric, and it looks a little bit like this. It's your operating income minus your operating expenses, and that gives you your net operating income. Very simple metric. That's one of the basics for how to determine how much money is this thing going to make me before I have to pay my mortgage and other things. From that number, from the net operating income, you will then be able to determine your cash flow. Cash flow is going to be your net operating income minus your mortgage expenses and your debt services. So that's going to be things like the mortgage itself, taxes and insurance if they're not already included in the mortgage, all of those debt service expenses. Once you've got your net operating income and you subtract out your mortgage and your other debt service, that will allow you to see at the end of the day, what is my actual cash flow? How much money am I bringing in on a monthly basis, an annual basis, after I pay all of the things I need to pay? That's key because nobody wants a real estate investment that isn't really a good investment, right? And so if it's not cash flowing, it's not a good investment. So that's an important number to be able to run. Once you know what your cash flow is, it's pretty easy to determine the primary metric that I like to evaluate for an investment, which is the cash on cash return on investment. And that is simply what is my cash flow broken down annually divided by the amount of cash I put into the deal initially. And that breaks down to a percentage, which you can then say, is this percentage of cash on cash return on investment worth me putting in this money? There are different ways to look at that. If you're simply buying a property and you're going to immediately turn it into a rental, there's no rehab to be done. There's no ARV to calculate after repair value. You would do that if you were going to have a fixer-upper that you had to put some money and time into. Your percentage of cash on cash ROI, you might have a different number in your head of what you're comfortable with based on how much effort do I have to put into this, how much time and energy do I have to put into this, and how much money do I have to put into this to start making an investment. Obviously, a turnkey rental, you might be okay with a smaller cash on cash return on investment because you didn't have to do much. You just bought it and immediately put a renter in it. If you're looking at something like a rehab project where you're going to buy it cheap, spend money and time fixing it up, and then you turn it into a rental, obviously you might want a higher cash on cash return on investment because you put more time and energy into it. You want your investment to pay you more for that effort. So those are it in a nutshell. So let's break down a tangible real world example. Don't worry about the numbers. I'm just using these to do the math for you If you have questions about numbers in your specific market, we can certainly break those down. Hit me up, shoot me a comment, we can talk about it. So net operating income. Let's assume that you found a property that rents for $2,000 a month and your operating expenses come out to about $500 a month. That leaves your net operating income at $1,500 a month. Now, again, the net operating income is before we cover our debt service, our mortgage, our taxes, etc. So we're going to take that net operating income, and in this same scenario, we're going to assume our mortgage, our taxes, our other expenses comes out to roughly $1,000 per month. That leaves us with a cash flow of $500 a month. Now, most people would tell you that a property that cash flows $500 a month is a very good investment. And I would say probably so, but it really depends on how much money you put into that deal in order to generate $500 a month in cash flow. So that is where our cash on cash return on investment comes into play. So if we have $500 a month in cash flow times 12 months for the year, that gives us an annual cash flow of $6,000. Now in this example, we're saying we spent $40,000 on the initial investment. So we simply divide $6,000 in annual cash flow by our initial $40,000 cash investment, and we see that gives us a 15% cash on cash return on investment. In that scenario, we would have a very good investment. We have a 15% return on our money and $500 a month in free cash flow. Now, you might say, well, I don't know what fairy tale land you're living in, but I can't find an investment property for $200,000. That just doesn't exist. That's for the next video where I tell you, one, it does exist, maybe not in your specific market, but it does exist. And two, you just need to run the numbers for your market to see if it makes sense. Now, not every market is a great investment market. And even within a not so great investment market, there are occasionally great deals to be found. It's how you find them and making sure you purchase the right investments to capitalize on that cash flow and that cash on cash return on investment. I'm going to do another video soon, and I'm going to talk specifically about how do you find those investments, what areas and what different markets might be worth you looking into. And I'm also going to do a video soon on the different types of investment strategies that you might want to employ. There are turnkey rentals, there are vacation rentals, short-term, long-term. There are flips where you don't rent them at all. You just fix them up and resell them immediately. There's some great strategies to blend those two, where you find a distressed property, buy it at a great price, fix it up to increase the value, rent it, refinance it down the road to pull out your initial investment so that you can use that money again for the next rental investment. That's called a BRRRR strategy, BRRR, buy, rehab, rent, and refinance. And that's a wise strategy if you are looking to find good initial value in properties that you can turn into long-term rentals. If you're not necessarily interested in long-term rentals, you just buy a really good property, fix it up, and resell it. Now, I will caution you about using the various rules of thumb that exist in the real estate investing industry. Some of the more popular ones are the 70% rule when you're talking about evaluating a flip property. There's also a 50% rule and a 2%, or sometimes known as a 1% rule, when you're trying to evaluate a rental property. I will tell you that while they're all decent baselines, they're all usually not that practical, and it's always wise to run the numbers for the individual property and the individual investment you're looking at. If you have questions, drop comments, please. Feel free to like and subscribe. I'm new to this, I'm just building my profile. Let me know what questions you have on real estate investing. This is a topic that I really love, and I plan to do several more videos in this series, but I would love to be able to address any specific questions you might have as we go forward. So drop me a comment, let me know what you're thinking. Let's go make some money.